Hello, folks. Brandon Chapman with you today. It's another Monday video for TheoTrade. It is August 5th, 2024, and what a day and what a difference a week makes. As the S&P is, we're kind of grinding it out. We're about, 25 minutes before the market close. S&P is down about 3.13%. We go to a one-day, 1 minute. You can see we kind of hit an apex here at around 10:30. This is Mountain Time. We've continued to kind of grind it out to the downside. And we're kind of in this position right now. So the title of today's session's Yen Contagion spreads to U.S. as carry trade erupts. And if you watch the market over the weekend, this was a real telltale sign is that the Japanese markets were down 12%. Trading was halted. We had the Korean markets, again, trading halted there. It looked like the Asian contagion was spreading to the United States as the yen continued to strengthen and unwinding the carry trade. If we look at the US dollar / JPY, you kind of see this precipitous decline in the US dollar Japanese yen, especially in the last week. You can see several large down days here in the last week, which means the yen is strengthening significantly against the dollar. You back this out to get a historical perspective, 20 years. Let's go a monthly chart and say, okay, you can see now that we're just at the beginning of the month and how much of a decline we're seeing. You would have to go back a long ways before we've had anything like this. 2016 was a bit of an unwind. We didn't quite have the same follow through the next month. We'd probably have to go back literally to the financial crisis and the big drop post Lehman Brothers. What does this mean? What does the carry trade really entail? The carry trade entails the Japanese, the Bank of Japan providing very cheap financing or funding. You're able to borrow in yen terms, convert to dollars, invest in US dollar-denominated assets. Okay, great. So you're pumping money into US investments, and as a result, those investments go higher. Well, let's go back to a yearly chart here, and we'll look at what's happened most recently, and this kind of double top type action. A little short for double top, but we'll bear with me here. How does this correlate to some investments, like, for example, Nvidia? Well, if you notice Nvidia, similar kind of double top action, the second peak occurring on July 11th. And it's pretty much been straight downhill ever since. Now, today we've recovered a little bit, but this thing was down quite a bit more, as low as almost $90 today. Well, let's go back to the peak here. July 11th happens to be Slurpee Day, right? 7-Eleven Day. Get your free Slurpee. Well, you know what? I'm not sure the Slurpee is the consolation here if you're investing in Nvidia. Well, notice what happened on July 11th right here. We saw the beginning of the carry trade unwind in the dollar yen. So what is this indicative of? It's indicative of yen being converted to dollars and invested in the dispersion trade that we've been talking about all year here at TheoTrade. And that dispersion trade of selling volatility and buying Nvidia or other stocks like calls, etc. That trade is blowing up here. And so again, as the yen is selling off, we're pulling money out of these assets like Nvidia. We're seeing weakness. And lo and behold, we talk about selling volatility. Something happened over the weekend. The VIX shot up to 65. So what happened here? They're buying VIX. Why? Because they sold it. Okay, so if you previously sell it, we suppressed the volatility for a long period of time. We started to come a little bit uncorked, and then all of a sudden on Friday we saw a big move in the VIX, and today we're seeing the VIX blow out to 65. We've come off those highs. We're sub 40 right now. But what happened is something blew up in the market, and again, this selling volatility, going long stocks like Nvidia, financing of cheap money from Japan or through the yen is not working. And what was the thing that kind of the catalyst last week that broke it? Well, certainly the Fed expected to cut rates starting in September. And of course, the Bank of Japan raising rates for the second time, no longer negative interest rate policy. So that interest rate differential between Japanese and the US is coming closer together. We start to see underperformance. We start to see a little fear, maybe a bump up in terms of the capital required to carry these loans and trades. All this stuff coming together to create this unwind. And then with the backdrop of bonds. So we're going to look at the 10-year Treasury note yield, TNX. You can see bond yields have been plummeting since the Fed announcement starting on Thursday. And what does this signal? The Fed is signaling here they're expecting the Fed to cut rates rather aggressively. And right now, the expectation is the Fed's going to cut 50 basis points in the next meeting in September. Now, in the interim, we have Jackson Hole in a few weeks here, like the third week of August. And again, we've got the Fed fund statement in September, but expectations in the next meeting. And even some people talking out there, oh, maybe they're going to step in early and cut rates. I mean, this is not a routine, oh, we're going to cut rates because inflation's coming down. This is real fear over future growth. And so as a function, we're seeing a little more correlation today. Virtually everything is being sold. Of course, the biggest seller today is technology. And so as a function, again, we're selling risk assets. We're bringing the market down generally. Now we can see that if I go to $DECN plus $ADVN, we can look at declining compared against advancing issues within the New York Stock Exchange. And what you're seeing is we're at about a 15 handle right now. So look at this left-hand scale over here. You're north of 910. This is a big time selling day. This is the biggest correlated selling day we've had since February 13th. Now, the market did test new lows, right? We saw some selling in March into early April. It was a decent decline in the market. So again, this does not mean we're done, but there is a fair amount of correlation. But the problem is this. Yes, correlation, but the fact of the matter is the S&P, we'll just use SPY here, only down 3% today. And I say only because the VIX hit 65. We may have to see some catch up in terms of the market selling to relate to what's going on in the volatility markets. And again, we may not see the VIX surpass 65 for years, but it doesn't matter, right? Cat's out of the bag. We've already kind of hedged this event to some degree, buying puts. We've not seen the breadth of liquidation and volatility, so be careful. If we were to go back to the flash crash in May of 2010, we kind of rebounded off a level like this. We actually finished a bit higher in its range, and then we saw the market roll over and test new lows again. So while this right now, if I draw a line from peak to trough, we're currently down, I guess I got to draw that down here a little bit, down about 9%. Given how much we appreciated off of our October lows of 38%, this does not reset things, right? This doesn't say, okay, we're down a little bit. We're in correction territory, 5 to 10%. This is a great opportunity to buy equities. Equities are cheap. The answer is no, right? This is a very small move relative to recent movements. It has not changed the valuation much at all. So we might see a correction on the order of 10 to 20% or more if we're really turning here. If the Fed is going to start to aggressively cut rates, we're on the precipice maybe of a recession. That may normalize the yield curve. We're looking at 50 basis points now. People may up the ante the more the market sells off here. And I'm not expecting an emergency meeting. This helps serve some of the purpose of the Fed and what they want right now. They want to see what? Inflation get curtailed. What a better way than to see economic slowing and a market sell-off. But at some point, they're going to come in, they're going to want ZERP, they're going to want to do a lot of things to help prop equities up. But right now, again, recognize that things have changed in the last week. This is not the same market today, even going back to the sell-off in April. These were over concerns of something bigger. This is over the bigger scenario happening. The yen carry trade unwind, the Fed potentially cutting rates because of economic weakness, and potentially aggressively cutting rates if we're talking about a 50 basis point cut in September. So just be careful in the market right now. HYG, so we walked through earlier today. I was on with Don, who walked through an HYG spread. I did one in my session back here in July 18th. We need it below 77, but the expectation, and this is the interesting thing with HYG, Treasury bonds are rallying, right? They're buying Treasuries and they're selling junk bonds. Okay, what's happening right now, the perception of risk, that risk spread is blowing out right now. And the fact of the matter is, HYG may have a lot more to go. If we look at the trade tab here, you just look at, for example, the yield 6.36%. This may have to go a lot higher before junk bonds begin to become more attractive. We're looking at down here probably 75-ish, maybe even lower. The spread we talked about today, buying 77, selling 77, 75. We just needed to get down into this area. And right now for HYG, we needed to get down below 77 for the 78, 77 for August expiration that's coming up here. So we need some further selling. If you look at LQD, these are investment grade bonds. We saw a little bit of rally here, but again, expect to see a little bit of widening in the risk spreads here, which may create pressure, especially if Treasury bonds kind of hang out and we don't see further buying there. This may roll around and start to sell off again with the broader market. So again, right now we're just at the precipice. We're just looking over the edge and we're trying to make a decision. Are we going to jump? And that leap is not up to you. It's up to all those that took significant amount of risk, leverage risk through the rally. And that's what's going to cause the market to see further selling if we're going to get it. But right now, we probably need to see some further selling for the market to kind of catch up with what went on in the VIX, what went on in the Japanese markets. Of course, we're going to have to see some follow through. Again, given the Japanese markets are closed right now after they start to reopen. So we have a lot of stuff going forward here. So we talked about today. So we talked about back on June 18th, putting on a hedge. We talked about probably the best way to increase your bullish delta if you wanted to do that today would be to roll that put at 535. We're rolling it further out of the money down here, capturing some of those profits, but still keeping the hedge on in case the market sees further selling, but bumping up the delta. Be careful as far as taking a lot of risk right now. Again, it's kind of magical thinking we're in the same position today that we were here, or that we were here, for example, in May, or even back in October. This was a bigger decline back here in that October timeframe. In fact, we go from high to low down here. That was about a 10% move. But again, the furiousness of the selling that's going on today, how high the VIX is, and all the periphery between Fed rate cuts, rate increases in Japan, the unwind of the carry trade, long-term bond yields, just prices blowing out, yields dropping, and the signal that provides says this is a cautionary event right now. And again, we're continuing to fade intraday into the cash session close. We start to break below here. We're kind of around that expected move area. We may see further selling here. So again, look for tomorrow, look for this week. It may take a little bit to shake it all off and then kind of readjust to what the market's going to be currently providing. But normally when you see these kinds of moves in volatility, in price, you typically maybe see a short-term bounce, but you typically roll over, test new lows. So be prepared for that possibility. Watch the volatility markets. But again, we need to see some breadth to the selling. We probably need to see a little bit more downside. Tomorrow can be a very interesting day. So don't get lulled to sleep if we form an inside day and we don't take out 523 on the SPY. Right? We may see an inside day tomorrow. Upside, we could see a little bit of drop in volatility. That may only be the bear market rally leading to the further or next leg lower in the broader market. Well, folks, that's what we got for the video today. Catch you back next week. It's going to be an interesting one.